Morning, listeners. This is Almus Market Mornings with Shikhar Garg, and we begin the week with an interesting set of actions. 2000 rupee notes, as we have all been hearing, have been withdrawn from circulation. Now, I wonder, can this bring in some short-term surge in liquidity and influence the borrowing rates? JK, I'd like to know from you. On the other hand, we are also observing equity indices performing quite well globally, with DAX making a new high on Friday, and Japanese equities have already been a darling for the investors. Nikkei and Topex are already trading at highs not seen in last 30 years, and the US debt ceiling conclusions are still elusive. So, JK, I'd like to know from you, what should we be expecting in such markets? And since we are already seeing some sort of surprising moves in currencies, what should we be expecting going forward?
Good morning, Shikhar. First, on to your question about the note ban and its impact. I think this is not a ban. And this is just a matter of removing out of circulation, which is already lower in circulation. And the impact is, I think there is no, dislocation on the economic activity or anything that is foreseen out of this. On the other hand, we expect increase in bank deposits and liquidity improving, and this can actually mean that more funds are available for credit, which has already been taking off, which has been on the higher side for quite some time. And coupled with the fact that we had a higher dividend payout from RBI to the government, which actually reduces the possibly reduces the borrowing from government, and all this will actually help the bond yields to come down. That is my take on this. So I'm not seeing any major negative fall out of this, leaving politics aside. So that's not a negative. But that said, the moves in the dollar rupee in the last few days is actually been a bit surprising, because not able to see any fundamental factors. In fact, on the other hand, we had improvement in the external macros, and also domestic economy has been doing very well. Dollar index also found a good resistance at 103.50 and all. We had some verbal intervention from Chinese. So all that should have actually been supportive of rupee to retrace, but it has not, and we are trading very close to a strong resistance at 82, 85, and I think that's likely to hold, because short term it does look over. But if there is no real fundamental trigger, we can actually see some pullback in USD/INR towards 82.50 in the coming sessions. That is my take on that. And also, don't ignore the fact that our reserves are closing in on 600 billion once again, and RBI has enough tools or enough armory to attack, counter attack the market in case there is a panic move. So I think rupee should stabilize around these levels and probably see some correction. But coming back to the global markets, Friday was a day when it was full of news-driven moves in the market. First of all, it was when Janet Yellen told the bank chief executives that more mergers may be necessary, and that resulted in the banking index losing somewhat, and not a very big down move, but definitely there was an impact, and that also impacted the yields. Then it was the turn of the politicians getting into the act. That Republicans were saying that president's team was being unreasonable and that no progress could be made. That abrupt turnout reflected in an unwieldy state of negotiations over a bipartisan deal to avert a debt default. However, in relief to the watchers, the Speaker McCarthy said on Friday evening on business news channels that the Republicans would return to negotiating table and the talks would continue into the night. And in fact, today morning we had a statement from the president himself that negotiations will continue, and that he already had a good discussion with McCarthy. So it's kind of we are all over the place as far as the market, the news or the debt is concerned. In the meantime, Yellen has not gone out of limelight. She said on that US odds of paying its bills by 15 June is quite low. Odds of paying its bills by June 15th is quite low. And that was the move from the politicians. And the final market moving event came on Friday from statements from Chairman Powell, which perhaps was the best that the market got for the day. Powell said the after effects of recent banking sector troubles is expected to take some pressure off the US central bank's interest rate hiking cycle. And in fact, his statements are being seen as kind of indicating pause. And what's more, today morning we had another Fed member, Kashkari, saying that he favors a pause in June meeting. And this was quite contrary to many statements that we got last week from several Fed members who were actually favoring a rate hike if it was warranted. But let's go by what market shows. Market pricing in the Fed fund future shows that it's a 90% probability of a pass in June. So that's a good news for the market. And now what happened is that on the yields, they had a wild day. 2-year yields, for instance, fell as much as 15 BPs after Yellen's statement on bank budgets, rose 11 BPs after net talks to be on the rocky boat, and then again fell 6 BPs after Powell's dovish comments. Again, in Asian time, we are starting slightly lower in the yields as it follows the latest positive statement on debt talks, which seemingly are quite positive. So that about a wild swings in the yields. And as far as the stocks are concerned, all three major stock indices ended the Friday session modestly in the red. Although they notched up quite a bit of gains for the week. In fact, Nasdaq was up 3% for the week. So none of the ongoing uncertainties seem to be affecting the stocks in a big way in a negative. In fact, as you mentioned, the Nikkei index trading at a 30-year high, or rather 33-year high, is probably improving the overall sentiment in the global market. They can pull to be on, on the point. We also had the German DAX index hitting a new all-time high on Friday. So we are not seeing anywhere any sort of negative reactions from the market in anticipation of any debt default or big recession, because even the data from US as we have been explaining on a day-to-day basis, quite mixed, and some recent data have been actually been positive. So on the stocks, I actually feel that the stocks are not going to do too much either way. If anything, there can be a slight positive bias because too many people have been carrying negative sentiment, or rather negative bias on the stocks. On the dollar, it retraced a bit lower by the close of trading day, under slight pressure in Asia also today. Tracking all the news and eventually latching on to Powell's comments. His comments were somewhat a pleasant surprise to the market, and even reading it as indicating a pause in June as well. Also, these statements came coming after continuously hearing some hawkish comments were a big relief to the markets. The rate futures, as I said, have now been almost pricing in, fully pricing in pause in June. And adding to pressure on the dollar were other factors like ECB member Schnabel saying that European Central Bank must continue to fight and tame inflation with determination because the wages are rising, fiscal policy is too generous, and inflation expectations are too high. Then there is a sort of verbal intervention from Chinese Central Bank after yuan hit a 5-month high of 7.0750. As they said, to strengthen market expectation guidance and to take actions to correct pro-cyclical and one-way market behaviors. And that saw the USD offshore yuan fall promptly from 7.07 to 7.02 on Friday itself. And now it appears it is actually been not going above 7.04 as well in today's trading. Yen was the other currency that the dollar got pressured with. Combination of very good data from Japan following higher inflation and also fall in US yields after Powell's comments, plus some sort of a risk aversion or you can say defensive approach due to debt ceiling talks actually led to yen falling rather dollar yen falling 1% from 138.72 to 137.41. In my view, dollar remains in one in a place of consolidation, correcting its overall state more in terms of time. We are in for a very quiet day today, but all eyes on debt talks, which are likely to resume later in the day. Thank you.
Okay, quite interesting, JK. And yes, the debt talks, although are continuing, it's the positive statements which bring in some sort of dip in the yields, while any change otherwise brings in some the movement on the other direction. It's been quite volatile on these particular fronts, folks, but we can definitely watch out for the other aspects of the financial markets with not much reactions on the equity side, even though there's a lot of gloom on the updates received, be it recession or the debt ceiling discussions. What we have also observed was the intervention by the Chinese central bank to maintain the ongoing or stop the ongoing weakness on the Chinese yuan. But what on the domestic front, if we have to talk about, yes, we can expect some sort of a pullback in the currency or the USD INR pair, as we also expect that there can be some sort of aid in the government borrowing with the high dividend payouts by the central bank, and as also probably by the increase in liquidity with the withdrawal of the high value banknotes. Other than that, we are also observing there's good chunk of armory being built by the central bank with the reserves approaching 600 billion. So yes, there's a good possibility that we can expect central bank to continue managing the volatility in the currency. While the talking about if we are talking about central banks, the move by the US central bank on the interest rate is being expected majorly on the pause side, with Fed funds future discounting a 90% possibility of a pause in the rate hikes. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.